Hello, my name is Vincent Merrick. I used AI to help organize data, format ideas in the workbook, and check calculations for correctness, but I reviewed the information myself and validated that it was all correct in the workbook. The peer feedback I received on my earlier drafts was very positive, so I didn't make any major changes to my original analysis. Instead, I added two things for the final draft: a closer look at what caused Eastman's ROIC to decline, and a specific recommendation for what management should do next. I chose Eastman Chemical Company, a specialty materials producer headquartered in Kingsport, Tennessee. It connects my management major, material science minor, operations interests, and earlier research on molecular recycling for this project. The issue for the company is whether Eastman can scale molecular recycling reliably and profitably. I chose it because it brings together operations, finance, sustainability, and material science, which all relate to my major. Customers want better solutions for plastic waste, but technology still has to be dependable, properly supplied, and worth the capital being invested. I audited SEC filings from 2022 to 2025 and compared Eastman with Celanese and Huntsman, which are businesses in the same chemical field. I then calculated NOPAT, invested capital, free cash flow, and ROIC. So for this, the overall pattern here is kind of what matters most. Eastman's after-tax operating profit stayed around $1 billion in 2023 and 2024, but fell to a little over $600 million in 2025. Capital remained around $11 billion, but free cash flow dropped kind of substantially. And the ROIC fell from about 9% to 5.5%. Eastman still performed better than Celanese and Huntsman, both which had negative returns in 2025 and 2024. However, Eastman's own decline was important because the company was still earning less operating profit while maintaining the large capital base. So for this is my final draft additions into my project. The ROIC decomposition kind of helped explain why the NOPAT margins show so much operating profit, or they show how much operating profit Eastman earned from sales, while the capital turnover shows how effectively it uses invested capital to generate those sales. From 2024 to 2025, Eastman's NOPAT margin fell from roughly 11% to 7%, and its capital turnover also declined, which tells me the ROIC was not caused by just one thing. Eastman was earning less from each dollar of sales while also producing fewer sales from the capital already invested in the business. This didn't automatically mean that molecular recycling destroyed value for the company, as they did produce more than 2.5 times its previous year volume and added about $60 million in 2025. The broader decline could also reflect weak demand, pricing costs, or the normal difficulty of ramping up a new facility. So I considered 3 possible choices for management, and I labeled them in this subsection here. Eastman could immediately move forward with another large facility. They could pause most of its recycling investment, or they could continue improving the Kingsport's location and only expand after specific goals are met. If I was in charge, I would choose the third option, a phased optimization strategy with stage-gated expansion. Eastman should keep operating and improving Kingsport while tracking product reliability, their yield, costs, safety, feedstock availability, customer demand, and their actual return on the project. Another major facility should only be approved after those results show that expansion is financially justified. I would not expand immediately because that would add more capital before the project's economics are fully proven. I would also not pause the program because Kingsport has already shown operating progress. It's generated additional earnings and created knowledge that Eastman can use going into the future. My recommendation applies operations management through bottleneck improvement and staged gates, where progress is slowly growing. It's also then backed by material science quality, their yield and processing reliability, and it's also guided through financial guidance from NPV, ROIC, and the cost of capital testing. Ethically, let's see. So we have final assignment questions that we kind of need to answer. So ethically, I think Eastman should independently verify its environmental claims. They should prioritize material that is truly difficult to recycle, and then clearly report the effects on safety, emissions, employees, and nearby communities. This would reduce the risk of greenwashing, which basically means making false claims about the environmental benefits. The biggest risk from my recommendation is that the success of Kingsport might not transfer perfectly to another facility. Feedstock supply, customer demand, or the price customers are willing to pay could change before a second facility earns an acceptable return rate. My proposition of stage gates will help reduce that risk, but it can't completely remove the risk. The stage gates essentially act as like barriers to where the company can stop and reevaluate what they're doing in terms of the financial gain, and things like that, just to determine whether or not they want to keep proceeding with opening up a new facility. With more time, I would actually build a financial model for the Kingsport facility. I'd calculate project level NPV and ROIC, compared the return with Eastman's cost of capital, and test changes within production, pricing, costs, and demand. This can give different levels and layers to the company to track whether or not they want to proceed in these certain aspects, or where maybe they could save financially in some of these ways as well. Overall, from the data that I've researched, it showed that Eastman remained stronger than its comparable companies, but in 2025, their decline was meaningful. My recommendation is to keep improving Kingsport, the Kingsport location, and only commit more capital when the operating results and project level financial analysis clearly support the need for expansion of the business. So that's kind of my overview. And then this final workbook is the new things that I added into my project from the previous assignments. So thank you for your time. Appreciate it.